Today, we're going to discuss fintech or financial technology. Financial technology has created a new sector in the economy by leveraging technology to provide financial services. These services are not necessarily new, although it's worth noting that some of them were previously unavailable or at least difficult to access. Fintech companies like Revolut make financial services available in ways that are easily accessible and often cheaper than traditional financial institutions. I think it's worth giving a few examples of how fintechs have disrupted the financial services sector, capturing a new part of the value chain. First of all, in the space of payments and money transfer services, fintech companies have developed products that allow individuals and businesses to transfer money easily and quickly. These services are often cheaper and more convenient than traditional bank transfers. Online lending platforms. We see fintechs that are now active in this space, and they have created online lending platforms that use technology to streamline the lending process and provide borrowers with easier to access credit. These platforms often use alternative data sources and algorithms to assess creditworthiness and offer loans to individuals who may have been rejected by traditional lenders. Buy now, pay later firms like Klarna, for example, have created online shopping platforms that allow access to thousands of merchants and enable customers to purchase items and spread the cost of the purchase into installments without incurring interest. We see investment platforms that allow individuals to invest in stocks, bonds, and other financial instruments easily and at a lower cost than traditional investment advisors. These platforms often use algorithms to recommend investment strategies based on an individual's risk tolerance and investment goals, and often offer free trading. And of course, digital banking. Digital banking platforms provide customers with an online banking experience that is more user-friendly and convenient than traditional banking. These platforms often offer features such as mobile banking, budgeting tools, and instant money transfers. And some providers, like Revolut, enhance their product with a number of other features. The growth of fintech has also created new job opportunities and economic growth in a number of countries. Many fintech companies are startups that have grown rapidly and created jobs in the technology, finance, customer service, and operations sectors. Additionally, fintech companies have increased financial inclusion by providing services to individuals and businesses that were previously underserved or even excluded from traditional financial institutions. In recent years, we have seen an exponential increase in the number of consumers who use fintech firms and challenger banks in their day-to-day transactions. I would suggest that at the moment, consumers primarily use these firms in addition to the main banking providers, but we have started seeing a shift in this trend. So, what instigated this change? Well, first of all, technology. We spend increasingly more time living our lives online, and we use our mobile phones or other devices to perform an increasing number of tasks. Most, if not all of you, will have access to a smartphone and stable access to fast internet connection. A significant number of services is now available online, and with these services migrating online, the opportunity was born for a new sector that would capture this new part of the value chain. From a payments processing to faster payments and everything else in between. These changes in technology brought changes in social attitudes. For example, exponential increase in online shopping compared to 10 or even 5 years ago, or the frequency of cash usage and cash transactions in everyday life, even for in-person transactions. Legislation, of course, plays an important role in the development of the fintech sector. Initiatives that support innovation and the adoption of new technology, especially within the financial services space, have helped the firms that operate at the junction of technology and finance. The Electronic Money Directive and the Payment Services Directive are excellent examples of how the law has helped reshape the financial services landscape. Today, we see renewed interest in defining the future of digital services, extending beyond financial services with initiatives such as the Digital Services Act and the Digital Markets Act that will regulate a wide range of online platforms and providers of services. And now allow me to move to one of my favorite topics, crypto. 14 years ago, in 2009, the Bitcoin white paper was published. Bitcoin was the first crypto asset and still remains the biggest in terms of market cap. But over 20,000 coins exist today, often referred to as altcoins, meaning alternative coins. Since 2009, crypto assets have moved into the mainstream. The total size of the crypto asset market in 2022, during the all-time high, was about $3 trillion. This may be insignificant compared to the size of the global economy, but it demonstrates the huge potential that the industry has and how it has created a new area of economic activity. The uptake in consumer interest has been primarily led by speculative reasons. To this date, the volatile nature of crypto and the limitations regarding to transactions processing, energy consumption, as well as the ease of use have limited the commercial use case, such as everyday payments. Some early experiments, such as, for example, in El Salvador, which has given Bitcoin legal tender status, have resulted in arguably less successful outcomes than expected. But let's take a step back. What is crypto? A crypto asset is a digital unit that represents value. It is not backed by a government or other central authority, like a central bank, for example, and it only has whatever value its users are prepared to pay for it in the open market. So, in this sense, it follows the laws of supply and demand. Crypto assets are primarily based on what is known as blockchain technology, a form of distributed ledger technology. When we speak about distributed ledger technology, or DLT, we mean a database that is shared across multiple parties, and there is no gatekeeper or central party responsible for maintaining that database. Different crypto asset protocols use different methods to validate new transactions and ensure that these are accurate and they reflect the true nature of what happened in terms of transfer and value transfers. The significant uptake in consumer interest and the high risk of consumer harm resulting from the volatility of crypto assets and the various problems occasionally reported in the news has also led regulators and policymakers to pay attention in this area. Initially, legislative controls were put in place to mitigate the risk of money laundering presented by crypto assets. This is a recent development, and as early as 2018, there were very few controls in place with regards to crypto. The EU stepped in with the implementation of the fifth AML directive, which created a registration requirement for crypto asset service providers with a national authority responsible for AML supervision. Fast forward into the future, and in 2023, we have MiCA, the Markets in Crypto Assets Regulation. This is part of the EU's digital infrastructure, and it is a new set of framework rules that aims to provide comprehensive regulatory guidelines for businesses active in this space, ensuring consumer protection, addressing information asymmetries and concerns around market integrity, and finally creating a level playing field for providers of services. I said before that primarily to this day, the adoption of crypto has been for speculative reasons. It is true that there has been a little utility in terms of real-world use cases and limited practical application for the various crypto asset-related projects. This lack of utility can be attributed to a number of reasons, primarily related to technical constraints, the volatility of crypto, and the lack of regulatory and legal certainty. The above notwithstanding, I have no doubt that within the next 15 years, we will see real life use cases and practical applications. Indeed, we already see financial institutions testing clearing and settlement with crypto, cross-border international transfers, payments processing with the use of stable coins. So I have no doubt that crypto assets will revolutionize fintech and the way consumers interact with their financial institutions. And more broadly, the technology has the potential to reshape the financial services landscape. As we wrap up, I would like to make a special mention to one example in particular: central bank digital currencies, or CBDCs. Central banks have recognized that the advent of digital technology has drastically transformed the world of finance. They have noted the increase in cryptocurrency use and consumer interest, and they are concerned about the inroads technology companies have made into the financial services landscape and the reduction in the role of cash in the economy, and how these could limit the ability of central banks to be effective in their roles of administering monetary policy. They have responded by starting to explore the possibility of issuing their own digital currencies. Currently, the ECB, the European Central Bank, as well as the Bank of England, are both exploring CBDC issuance, although admittedly no firm decision has been made. Central bank digital currency could be defined as money that a central bank, like the Bank of England or the European Central Bank, will be able to produce once the regulatory framework for doing so is established. They are digital because they are electronic representations of value recorded on the core ledger of the central bank, rather than physically produced like tangible banknotes or coins. Similar to privately issued crypto assets, a CBDC may be designed to operate on the basis of some form of distributed ledger technology, but it is different from crypto assets because they are backed by a central bank. While there is no expectation that central banks will seek to service customers directly, this will remain the business of private banks and other financial institutions. It remains to be seen how CBDCs may change the future of financial services. Widespread adoption would mean a shift of our monetary system away from private bank issued money in the form of deposits into central bank issued money in digital form. It is still unknown how such a change could affect payments, remittances, lending, which of course relies on deposits bank received from customers, and what it means for the participants in the financial services ecosystem.